What's up everyone, and welcome back to Explain the Charts. Today is October 28th, 2025, and we are looking at some monumental moves in the Nasdaq 100, represented by the QQQ ETF, which has just surged to new all-time highs. The big headline yesterday was that the Dow, S&P 500, and Nasdaq all notched fresh records. This rally appears to be fueled by strong momentum in the tech sector and a renewed sense of optimism over a potential U.S. China trade deal under the Trump administration. Big names like Nvidia, Qualcomm, Tesla, and Apple are leading the charge, with Apple reportedly nearing a massive $4 trillion market cap. Qualcomm has also been in the news for announcing new AI-enabling chips, positioning them as a direct competitor to Nvidia and AMD, which is adding fuel to the fire in the semiconductor space. However, it hasn't been a straight lineup. Just last week, around October 22nd, markets saw a significant slide in what was described as a risk-off mode. There were renewed fears of an AI slowdown, which led to significant profit-taking in high beta and speculative names that had seen parabolic gains since August. Investors were also closely watching how major tech firms are handling their AI spending, which created some temporary uncertainty. But as we can see from yesterday's price action, that dip was short-lived, and the bulls have come roaring back. So, with that context, let's jump into the charts to see how this news is reflected in the price and what we can expect next. Here on the daily chart for QQQ, the long-term trend is undeniably bullish. We've seen a powerful uptrend for well over a year, with a few notable pullbacks along the way. The most recent all-time high was hit just yesterday, October 27th, with the price closing at $628.09. We are currently in price discovery mode, which means there's no historical resistance above us. The key challenge for traders now is to identify where new support levels are forming. Looking back, we can see a significant consolidation period and previous peak in early October around the $611 to $613 area. The sharp drop on October 10th, from over $611 down to $589, directly correlates with those news headlines about tech fears and an AI slowdown. That drop found support around the $590 level, which was the previous high from mid-September, a classic case of prior resistance turning into support. Since then, we've seen a V-shaped recovery, culminating in yesterday's powerful breakout to new highs. This recent breakout above the $618 level is a very strong bullish signal. The volume on yesterday's move was also significant, confirming the strength of the breakout. Now, let's zoom in on a particularly volatile period from earlier this year to understand how the market behaves during sharp corrections. If we look at the period from late March to mid-April 2025, we see an incredibly steep drop. The price fell from around $490 all the way down to a low of nearly $402 in just a matter of days. This was a major correction, but notice the massive bullish engulfing candle on April 9th, where price surged over 12% in a single day. This shows that, even during aggressive sell-offs, buyers have been eagerly waiting to step in at lower levels, reinforcing the overall strength of this bull market. The recovery from that April low was swift, further cementing the dip-buying mentality in this market. Now let's switch to the 1-hour chart to analyze the most recent price action in more detail. Here we can see the anatomy of the recovery from the October 10th low. Price based for a few days around the $590 to $600 level before starting a steady climb back up. The $600 mark acted as a strong psychological support zone. Yesterday's session on October 27th was particularly strong, gapping up and running higher throughout the day with very little pullback. This indicates strong institutional buying pressure, likely driven by the positive news cycle. The immediate support on this time frame is now the low of yesterday's session, right around the $624 level. As long as the price remains above this level, the short-term trend is extremely bullish. A break below that could signal some consolidation or a minor pullback. Finally, let's drill down to the 15-minute chart to look at yesterday's breakout action. We can see the market opened strong and never looked back. There was a consistent trend of higher highs and higher lows throughout the entire trading session. Notice how the volume was heaviest at the open and during the final push into the close, which is a sign of a healthy trend. The price action ended the day consolidating near the highs, suggesting that the bullish momentum could carry over into today's session. For day traders, the key levels from yesterday would be the intraday support that formed around $626 and the session low at $624. Any retest of these levels that holds would be a bullish sign for another leg up. So, to recap everything, let's go back to the daily chart. The market sentiment is overwhelmingly bullish, supported by both positive news and strong technicals. We are in price discovery mode, making new all-time highs. Your key support levels to watch are, first, the intraday level of $624. Below that, the major breakout point is between $617 and $618. A much stronger support zone sits at the previous highs around $610 to $613, followed by the major psychological level of $600. Now for some potential scenarios. A bullish continuation is the most likely scenario. I'd give it about a 65% probability, as long as we hold above the $618 breakout level. In this case, we would look for price to target psychological round numbers like $630, $640, and even $650 in the coming days and weeks. This scenario is reinforced by the current positive news flow regarding tech and trade deals. A bearish reversal or pullback scenario, which I'd place at a 35% probability, would be triggered by a decisive break back below $618. This would suggest a failed breakout or bull trap and could lead to a retest of the $600 support level. Negative news, such as a breakdown in trade talks or poor earnings from a major tech company, would increase the likelihood of this scenario. Things to watch for upcoming earnings reports from the remaining Magnificent Seven stocks and any further developments on the U.S. China trade front. Keep a close eye on trading volume. If we see prices continue to rise on declining volume, it could be a warning sign of exhaustion. Thanks for tuning in to Explain the Charts. Remember, this information is for educational purposes only and is not financial advice. Always conduct your own thorough research and analysis before making any investment decisions. Trade safe, and we'll see you in the next video.